Let's talk about two forgotten growth stocks where at least they were growth stocks back when they were at their all-time highs or close to it, because right now they're down between 80 to 90%. And to be honest, I don't even know if we could categorize both of them as growth stocks anymore. Maybe one of them, yes, but definitely not both of them. Anyways, both these companies reported earnings in the last couple of days, so that's a great way for us to actually check on them and see what has happened. One stock has gone up quite a lot while the other has come down. Now, stock number one I want to touch on is Fiverr International. Fiverr has a market cap of just over $1 billion, and in the last 5 days, the stock is up close to 30%. Now, as you can see, in the last 3 years, Fiverr is down 82.8%, right? If you look at where it was here back in February 2021, I mean, the stock and actually most stocks were up by quite a lot. And yes, since then it has been quite horrible for the stock. The company itself has become more and more profitable, but like I said, it went from being a growth company to now a company that grows profitably. So if you look at what the analysts are expecting, fiscal year 2024, sales growth of just 7.7%, but EPS growing closer to 20%. If you look at fiscal 2025, sales growth close to 8%, EPS growing close to 12% year over year. And then going to fiscal year 2026, sales growth reaccelerates close to 11% growth year over year, but EPS staying flat. Right now it has a forward PE of 11.4 times. Now, currently the average analyst price target, and this is after the earnings report and after the earnings jump, it sits 15.27% higher than the price we're at today. As you can see, the average analyst price target did go up from around $31 to now $33.73. If we look at a couple of pricing metrics, yes, it's true that on all of them, the last 3 years compared to its 3-year mean, it's much lower, but that's because one previously, like I said, this was a growth company, so it deserved a higher multiple. Right now, it is much lower, but then again, when you're growing at this pace, do you deserve to have a higher multiple? Probably not. Maybe a little bit, but not by much. So, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, the third quarter overview and financial outlook looks like this. Revenue came in at $99.6 million, growing 8% year over year. Gross margin on a GAAP basis, 81%, non-GAAP 84%. Active buyers continues to come down, so that's down 9% year over year to 3.8 million. Spend per buyer is up 9% to $296. Again, okay, they're focused on less buyers, but buyers that spend more. But yeah, I mean, if this number continues, if active buyers does continue to go down, then you will run into some issues. Take rate continues to go up, so that's amazing, 33.9%, that's up 260 basis points year over year. GAAP net income of $1.4 million, adjusted EBITDA of $19.7 million, and adjusted EBITDA margin of 19.7%. As for the outlook, for Q4, they expect revenue to grow 9 to 12%, with an adjusted EBITDA of between $19.5 to $21.5 million. As for the full year 2024, they did raise guidance, so revenue growing now between 7 to 8% year over year instead of 6 to 7, and adjusted EBITDA to come at $74 million at the midpoint instead of $71.5 million. They also said that July is showing promising signs to drive spending growth among larger customers, leading to more buyers spending over $10,000 on Fiverr annually. As for their strategic capital allocation priorities, which they gave us last quarter, they said this: 1, they're going to invest in product innovation to drive growth. 2, optimize our balance sheet and capital structure. 3, share repurchases to deliver shareholder value. 4, strategic M&A to compound our growth. We expect to continue executing a disciplined capital allocation strategy to pursue growth, improve profitability, and deliver long-term shareholder value. They have also set a 3-year target to reach 25% adjusted EBITDA margin by the end of 2027 and a 14% CAGR in free cash flow for 2024 to 2027. With our strong results in Q3 2024 in both revenue and adjusted EBITDA, we believe we are well on track to deliver those targets. Agreed. Now, as for this quarter, as we've seen, revenue growing close to 8%, cost of revenue did increase 25.33% year over year. Gross profit increased 4.23%. Now, research and development did come down a little bit year on year. Sales and marketing did increase. G&A did increase the most here for expenses. So total operating expenses is up 5.53% year over year. Shares did come down year over year because of the share buyback program. And so looking at what analysts are expecting sales-wise growth there, we have seen that. But now if we look at free cash flow in the trailing 12 months sits closer to $80 million. And that's expected to be $94.4 million in fiscal 2025, and then basically flat to down-ish in fiscal 2026. Overall, over the last couple of years, we can see that gross profit margin has been stable, has increased a little bit. It's up 5.10% since Q1 2018. Operating margin has been flat-ish for the last year or two, but gross profit did increase quite a lot. It's up 525% since Q1 2018. And net income, well, in the last year or so, net income has turned positive, but as you can see, it's up and down, up and down. So basing ourselves on these numbers right now, trailing 12 months, free cash flow close to $80 million, terminal growth rate 4.26%, and a discount rate of 8.22%, we can see that the implied growth rate sits at 0% and the intrinsic value is still 43% higher than the price we're at today. Now, okay, let's add, let's say, execution risk. So discount rate, let's put it at 10%. And even at 10%, we can see that the implied growth rate is still 0% to justify today's price. Now, again, with buying Fiverr, you're not buying a high growth company, right? As we've seen with the numbers, but you're buying a growing company that is profitable, free cash flow generating. They probably are going to do some M&As and repurchase shares along the way as well. So yeah, definitely not the same company as it was in 2020, 2021, growing extremely quickly. But now you're getting a company that is stable, growing a little bit, and it's profitable. Now, quickly looking at the stock, we can see that it has been making higher lows since April 2024. And now we're actually, well, we were over $30 after the earnings report, but now it seems like we are back at the same point as we were here in February of 2024. Also, it tried to go over $30, did not succeed, and so you're seeing basically the same resistance right now. Moving to company number 2, and that company is called Roku, has a market cap of $9.27 billion, and here as well, as you can see in the last 3 years, it's down close to 80%, but actually since its peak, it's down a little bit more than that. Now, Roku did drop 17.3% after it reported earnings. And to be honest, I mean, you can see there was a smaller rebound already, but it's, in my opinion, a big overreaction because the report was really not that bad. So yeah, maybe it could be an opportunity for those that want to add to their position or always wanted to open a position in Roku. Now, with regards to Roku, this is a company that is growing a little bit faster than Fiverr, but still not profitable, right? Yes, free cash flow profitable, but EPS-wise, that's still not the case. If we currently look at the average analyst price target, that sits 19.32% higher than the price we're at today. Then if we look at some pricing metrics here, of course, there's no forward PE because, well, there's no E. Then if you look at EV to EBITDA, 34.4 times, of course, much lower than the 4-year mean here. Price to sales of 2.1 times, not the most expensive one out there. And then price to free cash flow, that's in the last 12 months, sits at 62.2 times. So, okay, definitely not as cheap as Fiverr. And so if we look at their performance for last quarter, streaming households reached 85.5 million. That's up 13% year over year. Streaming hours up 20% year over year to 32 billion. So that's quite a good performance. But if you look at ARPU has grown by 0% year over year, yet streaming hours is up 20% year over year. Interesting, right? All right, continuing here. Platform revenue increased 15% year over year. Devices revenue is up 23% year over year. But as you can see, Q3 of last year was quite a weak quarter. And so total revenue is up 16% year over year, first quarter with revenue above $1 billion. As for gross profit, for platform that has increased 30% year over year, whereas device gross profit, still a loss, but a small improvement quarter over quarter, but year over year, not that much, actually 24% worse. So total gross profit has increased 30% year over year, thanks to platform. As for operating expenses, that's down 28% year over year, with some big increases here in R&D, down 37% year over year. Sales and marketing is down 23%, G&A is down 22%. Loss from operations, big improvements there, an improvement by 90% year over year. Adjusted EBITDA has increased by 126% year over year, and adjusted EBITDA margin for the quarter is 9.2%, up 4.5 percentage points year over year. Cash from operations is actually down 37% year over year, but free cash flow, both of them are trailing 12 months, an increase of 56% year over year. As for next quarter, and that's probably why the stock is down, because it missed the expectations a little bit. So total net revenue, $1.14 billion, total gross profit, $465 million, net income loss of $65 million, and adjusted EBITDA of $30 million, which you can see is lower than where we were this quarter. Now here you can see it clearly, you can even pause the screen if you want. So total net revenue increased 16.48% year over year. Total cost of revenue only increased 5% year over year, and total operating expenses down close to 28% year over year. So definitely moving in the right direction. Now you might ask yourself, who's buying these things, right? Who's buying Roku TVs? Well, I always get the same question and they always give the same answer. So Roku continues to benefit from our devices' simplicity, value, and delight. The Roku operating system has been the #1 selling TV OS in the United States for more than 5 years. In Q3, sales of TV units powered by the Roku OS were greater than those of the #2 and #3 selling TV operating systems combined. Not bad, right? The Roku OS was also the #1 selling TV OS in Mexico and Canada, where we continue to grow scale. We have broad retail distribution of Roku streaming devices, including Roku branded TVs, which are available from popular national retailers such as Amazon, Best Buy, Sam's Club, Target, and Walmart. As for the Roku channel, in Q3, the Roku channel was the #3 app on the platform by both reach and engagement for the third straight quarter, with streaming hours up 80% year over year. Additionally, the Roku channel hit an all-time high on Nielsen's The Gouge, I think that's how you mention this, ranking for August, representing 4.1% of all TV streaming time in the United States. Our position as the lead into TV continues to drive significant growth. Now, my big question is still this: how can you increase streaming hours by 20%, but you're not able to monetize your users more, right? I mean, even if it was a little bit, why is it still at 0%? Like ARPU growing 0%? It's quite strange. Now, if you look at what the analysts are expecting sales-wise and free cash flow, for fiscal 2024, they expect sales to increase 16.4%, free cash flow to be around $200 million. For fiscal 2025, free cash flow growing by 71.7% and revenue by 11.4%. And then they're expecting revenue to grow by 12.5% and free cash flow to be around $532.4 million. As for gross profit margin, net income, and operating margin, you can see that gross profit growing has not been an issue, right? This shows you since Q1 2016 has grown by quite a lot, but even since 2019, gross profit has grown, so that's great. Gross profit margin has been stabilizing now, but of course we were higher back in 2021, but maybe we're going to make our way back up. If you look at operating margin, yes, this is when the company was profitable, right? 2020, 2021. Since then, we have been recovering from Q1, the lows here, Q1 2023, which was negative 24.4. We're now at negative 3.4. So we're making our way back up, and you can see this already with net income closing in to become break even. And so here, if we do the same thing, we plug in the free cash flow number, trailing 12 months, terminal growth rate, discount rate, we can see that the implied growth rate is now here a bit higher than, of course, Fiverr, 15% So growing free cash flow 15% for the next 10 years to justify today's price. Now, as we've seen, free cash flow is expected to grow, especially in the next couple of years, much faster than that, right? Here in year 9, it's expected to reach a number even lower than what we've seen for fiscal 2026. So yeah, 15% is definitely achievable. And so looking at the graph right now, I mean, it's not great because we're back under the 20, the 50 and the 200-day moving average. RSI is neutral, but it's definitely not having any positive momentum. I mean, we are now in the range where previously the stock did trade around that for a couple of weeks, right, at the start of this year. So maybe $63, $64 or so could be a support, a rebound area. Remains to be seen. Of course, the stock did go lower, touched on $60, and then buyers came in a little bit. Now remains to be seen what happens in the coming days. With earnings report, we've seen this already. One day it's red, then the next day it's green. It usually takes the market a day or two to figure out what they really thought about an earnings report. So overall, that's about it. We've covered both of these companies for a long time actually. So I thought, hey, respect the viewer here. Let's review both of those earnings report. I currently have no positions anymore in Roku and Fiverr for quite a long time right now. I honestly have no interest in opening a position despite it being down a lot. I think I've got better positions and better companies in my portfolio, but hey, there's always value to be found in other companies. It just happens to be that does not interest me anymore. So that's all I've got for you right now. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.